Introduction: the secret engine of modern money. Most people think money is created by governments printing bills in some secure facility. They imagine vast printing presses churning out crisp new dollars under heavy guard. But that's not where most money comes from. The real money machine isn't run by the Treasury or the Federal Reserve. It's run by your local bank. And the process is so simple, so elegant, and so dangerous that once you understand it, you'll never look at your savings account the same way again. Here's what they don't teach you in school. The invisible engine that creates most of the money in your economy is called fractional reserve banking. It's the trick that turns your small deposit into a mountain of digital credit. Moneybag, the invisible money machine. Understanding fractional reserve banking. What fractional reserve banking really is. Fractional reserve banking is a system where banks are required to hold only a fraction of their customers' deposits as reserves and are free to loan out the rest. The fraction, a small percentage, historically about 10% for large U.S. banks, of every deposit must be kept in the bank's vault or on deposit with the central bank. This is the reserve. The rest, the remaining, larger portion of the deposit is lent out to borrowers, individuals for mortgages, businesses for investment, etc. The bank operates on the premise that not all depositors will demand all their money back at the same time. This allows a single deposit to be used as the basis for multiple loans. How banks multiply money that doesn't exist. This lending cycle creates new money, not by printing it, but by a phenomenon known as the money multiplier effect. Initial deposit. You deposit $1,000 in cash at the First National Bank. First loan. First National keeps the required 10%, $100, as reserves and loans out the remaining $900. New deposit. The borrower deposits that $900 into a bank account, Second National Bank. The cycle continues. Second National keeps 10%, $90, and loans out $810. This process repeats over and over. The stunning math. Through this multiplier effect, that original $1,000 deposit becomes the foundation for up to $10,000 in total money supply circulating in the economy. This money is created not by printing presses, but by accounting entries, digital dollars backed by nothing more than the borrower's promise to repay the loan. In the United States, roughly 90% of all money in circulation was created this way. Why this system benefits banks but traps ordinary people in debt. The fractional reserve system is a powerful driver of economic activity, but its structure inherently favors the lenders and creates systemic reliance on debt. Benefits for banks. Profit generation. The entire business model is based on collecting interest on money they essentially created out of thin air. They profit from the spread between the low interest paid to depositors and the higher interest charged to borrowers. Leverage. The system allows banks to control and lend out assets far exceeding the cash they actually hold, creating enormous leverage and profit potential on a small reserve base. The debt trap for individuals. Systemic debt requirement. Every dollar created through this process is a dollar that must be repaid with interest. If all the money in circulation is created as debt, the total amount owed, principal plus interest, always exceeds the total amount of money actually in existence. The mathematical impossibility. It is mathematically impossible for everyone in the economy to repay their debts because the money for the interest payments was never created. Only the principal was loaned into existence. The economy is forced into a perpetual cycle of needing more lending just to create the money required to pay back existing debts. The hidden dangers of a money system built on credit police. The complexity and leverage of fractional reserve banking, especially when combined with modern financial engineering, introduce severe systemic risks. 1. The fragility of confidence, the bank run. The core vulnerability is the impossible promise inherent in the system. Banks promise your money is safe and available whenever you need it, but they've already loaned most of it to other people. If a large number of depositors lose confidence and demand their cash, a bank run, the bank cannot fulfill its promises because it only holds a small fraction in reserve. As the script noted, the first recorded bank run happened in ancient Rome, and the pattern has repeated for centuries. 2. The debt collapse and deleveraging. When borrowers default on a massive scale, like during an economic crisis, the money that was created as a loan vanishes. The digital entries disappear, leading to a sudden, rapid contraction of the money supply. This is what happened in 2008 when mortgage-backed securities, complex financial instruments built on thousands of individual home loans, suddenly became worthless, causing billions in assets to simply evaporate. 3. Creation of illusory wealth. Fractional reserve banking creates the illusion of wealth by flooding the economy with credit money, leading to bubbles in asset classes. People feel richer, but this prosperity is based on debt rather than the actual production of goods and services. When the money supply inevitably contracts due to defaults, the wealth evaporates. Conclusion: the house of cards. This is the mathematical impossibility at the heart of fractional reserve banking. The total debt in the system will always exceed the total money supply. Every dollar in your bank account exists because someone somewhere went into debt to create it. The money you think you own is really just your share of a collective IOU. The system works smoothly as long as everyone plays their part, as long as confidence holds. But confidence is fragile, and when it breaks, the money that seems so solid vanishes back into the air it came from. The banks know this. The government knows this. The question is whether you'll understand it before the next inevitable collapse.